All right, set talks, because we're on set of the Focus Compounding Podcast with Andrew Kuhn and Geoff Gannon. Hope everyone is having a great day. So let's talk about one of the most common questions I feel like newer investors tend to talk about, and I think it's because of they hear other people talk about a lot, and it's really just investing in dividend stocks, right? I feel like whenever you hear people talk about stocks that maybe aren't in sort of the same crowd that we may, follow or whatever, it's always, well, I want to buy like dividend paying stocks and stuff like that. So like, what are your thoughts on that and why you think that, because we've talked about before, if you were running your own capital, for example,
right,
and you want to generate some sort of income off of that portfolio, you're like, no, I would not look for a dividend specific portfolio. And we're not, saying if you do that, that's bad, but maybe you could take something away on your thoughts towards what you would do, instead of just seeking out a dividends-paying portfolio.
Yeah, I think it's natural for people to want that. The same way that, it's natural for an insurance company to think we should just have a portfolio of 100% bonds, and that would be fine. Instead of thinking maybe we should put a third in cash, 2/3 in stocks, and it'll get as good a result or whatever. For an individual, you can decide on that. And it may make sense for you to have things that go up in value then sell them, and that's how you get income from them, instead of trying to separate out the two streams that way. But yeah, I think people do it because the idea of getting passive income is a very popular idea for people, the same way that people are attracted to real estate that way. I don't know returns are better in real estate by buying an apartment building that's already producing cash flow than by building something and flipping it. But people like the idea of passive income better than the capital gain sort of thing.
Yeah, it's because they'll buy like a dividend, portfolio or whatever, and then the stock drops like 10 or 15%. It's like, well, it still pays a 2% dividend or whatever, and that's the way that they rationalize it.
Yeah, the biggest other thing to keep in mind is that, just like what I was saying with insurers and stuff, a problem that people will have is they'll target a rate that they need, and then they'll want that return regardless of the safety of the dividend. Where it makes much more sense to think, I have a certain standard of safety, and then what's the best yield I can get for that? Instead, they think, what yield do I need? And by doing that, you end up in some things that are the first to cut their dividends, right, during a time like COVID. As opposed to, we own a stock that has never paid a significant dividend, but it's kept paying it through COVID. It's just a fairly cheap stock, and it's not hard for them to pay the dividend. But if you have a payout ratio of, really high, and you've been raising your dividend every year for a while, now you'll probably cut it because it's a use of cash that takes up a lot of your cash. So people tend to look for too high yielding dividends. Better to look for ones that have the ones that have increased it every year for many, many years might be the better list to look at than the ones that are paying the highest dividends.
Yeah, I was looking at someone's portfolio once, and he was like, well, I'm getting, I forget what it was, probably north of 8% in dividends on it. But then I looked at it and it was all like junk. Absolute junk.
Sure.
And I think actually since a lot of those companies are either out of business or they cut their dividends or, just not around. So, right. What, if you were structuring a portfolio for income purposes, what would you do?
I don't think I'd buy stocks.
Really? Okay. So what would you do?
You can buy trusts. And there's some wonderful trusts. We don't own them and stuff usually, I think, because of tax complications for clients and partners and things. But as an individual, I would buy trusts. I can find trusts that are illiquid, hard to do sort of trusts that are you can just read what's in the trust document, what royalties they collect and stuff, and they're very, very safe and attractive. And there's a bunch, I could do half a dozen of them that I could think of. It creates tax problems for you, and they're weird securities, but they don't show up in the screens of people for dividends. I also think there's some preferred stock that can be attractive, and there's also some junk bonds that can be attractive. We've mentioned things about Carnival as a stock and stuff, but things like that have fairly high yielding debt that is secured by pretty good property, sometimes by companies that, in case if there was a default, would not lose 100% of the value of the bond. Whereas once that dividend is gone in a stock that there's something seriously wrong with, the common stock can go to zero.
Yeah, sure.
When we're talking about a lot of these bonds, they're not going to go to zero. I mentioned a preferred stock that I should have bought. There are some preferred stocks that are pretty attractive. There's a handful of preferred stocks that are they're effectively just like bonds, because the common stock is always going to pay a dividend, and because the company doesn't actually issue bonds. Most preferred stock, I'd say, avoid. People look at preferred stock of banks and things, definitely avoid that stuff. You've got to read this stuff carefully. But if I was doing it, I would if someone asked me to create a portfolio for income purposes, really, it would be a portfolio full of trusts and preferred stocks probably, with maybe some bonds, although sometimes I think that's a more efficient market than the others. But preferred stocks pretty inefficient.
Cool. Well, thank you so much for being a subscriber to our app. Be sure to email me, focuscompounding@gmail.com, and we will take your question and answer them just like this. Thank you so much, and we will see you in the next video.